We've just held Argo Infrastructure's annual general meeting, and now I'm joined by our Managing Director, Jason Beddow, who's going to discuss global listed infrastructure, as well as some specific Australian infrastructure stocks. Jason, I wanted to start by asking about the performance of global listed infrastructure, which has lagged the strong performance of broader global equities and Australian equities over the last 12 to 18 months. Can you tell us why that is?
I guess in some ways it's fairly fundamental. A lot of infrastructure carries a lot of debt, particularly utilities, because I guess they're an essential service and their cash flows are, I'll say guaranteed, but they're almost an annuity and they can carry a lot of debt. In an environment where we've seen interest rates go up far quicker and further than anyone expected, say 12 or 18 months ago. And so, these stocks have been caught directly in the firing line. Secondly, I mean, if you go back a year before that, though, infrastructure had quite a good year relative to general equities. In the environment didn't suit equities. In the Australian market, 2002, the equities were actually down, and listed infrastructure outperformed by about 18%. So some of that's a bit of a mean reversion. Over 2 years, it's not as dramatic, but certainly over 1 year, with the interest rate move, infrastructure globally, including the few remaining Australian infrastructure stocks, have all been pretty poor.
And so you mentioned the Australian stocks, and there are only a handful of Australian listed infrastructure stocks. How have they performed as well over the last 12 months?
It's a fairly similar trend. I mean, if we think about, I guess, two that are probably the most commonly known would be Transurban and APA. There's a couple of others left. That's a fairly significant underperformance if you go back to, I guess, May of last year when we had the first RBA rate hike. And if we, I guess, plot a chart of that, I mean, they are well down as interest rates have gone up. And even though the Fed and the RBA have paused, two different markets, the bond curves are extrapolating higher rates for longer. So the curves are still rising, which means that longer duration as these companies need to refinance will have a higher cost of debt. And, they continue to be weak. So, I guess in time, we would imagine there'll be an interest rate cycle, there'll be an economic cycle. Interest rates, will stabilise and then will be cut. And we'd expect, some mean reversion or normal returns from these stocks over time. But clearly at the moment, they're right in the nadir of underperformance.
So looking further, perhaps to the medium and longer term, what are some of the key features of the outlook for global infrastructure?
Well, look, I guess one sector is still essential. These are essential services and, power, water, gas. So we think, they have a place and, they should be okay. There's some very high growth parts of infrastructure. Decarbonisation is going to require a lot of assets built, whether they be, solar farms, wind turbines directly or transmission. There is trillions to be spent around the world. The other sort of, I guess, growth area or structural growth is data. Data just increasingly grows on a daily basis. So we need data centres, telecommunication towers. So there's huge demand for infrastructure assets. I guess the challenge is in many parts of the world, the government are building these assets. They're government funded, they're not privatised. And these assets then need to, I guess, make their way into private hands. So there's a lot of, I guess, money looking to invest in infrastructure. But as we see with the Australian market, there's not as many opportunities as you think. So, we just probably need to be patient, I think, through the next 12, 18 months as this economic cycle plays out.
And what impact does that have when there are few infrastructure assets to invest in? What does that mean?
Well, I think if you want exposure to the asset class, I think a vehicle like Argo Infrastructure is fantastic. It's across the globe, many different subsectors of infrastructure. So, Transurban tollways and APA's pipelines. There's really not much left here to invest in. So if you want exposure to some of these other sectors that will grow, being able to invest in one vehicle is good. I guess the other challenge short term is the yield, is with cash rates where they are. A lot of people used to buy infrastructure for the steady yield, the attractive dividend they paid. While a lot of them don't pay franking, and the cash rate at 5, it's probably a reasonable alternative for those, particularly those that are more cautious on the market short term, to maybe just have their money in cash, earn 4.5%, 5%, whereas the yields on many infrastructure stocks is only around that level. So I think that's probably again a short term sort of inhibitor.
Certainly an interesting space to watch. Thanks for your time, Jason.
Thanks, Meredith.